Let's talk about Amtek Auto now, and that stock is in focus because of the earnings that it came out with in the fourth quarter. The company reported a loss of 528.7 crore rupees. Today, the stock is up about 3.5% at 33 odd rupees per share. The loss was there in the third quarter itself, so it's yet another quarter when the company posted a loss versus a profit of 129 crores in the same quarter a year ago. The total income came in at 651 crore rupees versus 954 crores in the same quarter earlier, and EBITDA was much lower as well in this particular quarter at 120.6 crore rupees. The stock is looking good. They have got a huge debt on their books, and of course the focus ahead is going to be as to how the company manages to reduce that. We have the management now joining us, Mr. John Flintham, Vice Chairman and Managing Director. Sir, thank you very much for joining us. So a net loss in yet another quarter. What happened this time?
No, I mean, there's a substantial, in terms of the PAT, there is a substantial exceptionals that's gone through the books. It became our financial year end of March 31st. So there was changes to the depreciation. There was also some inventory write-off and some share sale loss. So fundamentally, there was in terms of a consolidated figure, the loss was 580 crores, of which nearly 510 was the exceptional loss. The net PAT was slightly better than last quarter.
Right, so the loss, of course, on a consolidated level as well was quite strong. Your finance cost continues to remain high, and in this quarter it has gone up even further. What's the outlook ahead on that front?
Yeah, obviously we launched our debt reduction program a few quarters ago, and the big chunk of that is coming from the sale of Amtek Tech4, our subsidiary overseas. This is going extremely well. The program's very much in line with expectations. I did say it would probably take till maybe August before we finalise the sale. We have two firm bids that have been selected out of many bids. Two firm bids which we will close down onto one of those in the next few weeks, and then we'll close out that deal in line with the plan of closing out by August. The sale of non-core assets in India is slightly slower, but we expect again to sell some small assets in the not too distant future. But the big chunk of the asset monetization program we declared was the sale of Amtek Tech4, which is on track. In addition to that, I think we've also recognized that we need to make sure we bring our debt in line with our revenues and profits. And therefore, we've also, as a management team, embarked on another part of the debt reduction program by looking for institutional investors to come in to buy equity to, again, overall reduce the debt. Our target in terms of debt, we have a consolidated debt of around about 14,800 crores, which obviously is too high against the revenues. But with these actions, both in terms of the asset monetization and also the investor program, we hope to get that debt down to around about 6,000-7,000 crores, 2/3 reduction on where it is today.
And how will this actually happen? Is that going to be only via the sale of your non-core assets, or are you seeing some sort of an improvement as far as your revenue visibility is concerned?
Actually, in the immediate future, I don't. I think that the markets still remain challenging and very similar to where they are today. India market still remains challenging and fragmented. Brazilian market is extremely challenging, but a relatively small portion of our overseas business now. Europe is performing very well across the board, including the UK, which is also performing very well, driven by Jaguar Land Rover, who is a big customer of ours. And Asia is doing okay, much in line with expectations. And I think that still remains today. I think India is still a challenging market. I'm hopeful that things will pick up, but in terms of where we're looking at, second half of this financial year, we should start to see some pickup in our domestic Indian markets. But as we stand today, the shift in the global footprint means that 76% of our revenues now come from overseas, which was around 50% not long ago.
Talking about the domestic business, it was quite weak in the third quarter. You're saying that the situation remains challenging even right now. In Q4, looking at the numbers, do you see it has probably bottomed out, and from here things are expected to look better?
Well, the quarter we are reporting, January to March, is our last of our financial year. We've changed our financial year in line with the government requirements. So we're now in Q1 of our new financial year. I would expect that the domestic market should start showing signs of pickup in Q3 of this financial year. We're not seeing anything that really shows anything before then.
Right, so Q3, something that you look forward to as far as pickup of some signs in the domestic space is concerned. What about the growth in the overseas business? How was the performance there?
Again, I think it's, as you see, you can see the growth in terms of where we are. 76% of our revenues now come from overseas. We've seen around about a 5 or 7% growth in our European businesses, which is very satisfactory. Usually they're pretty stable markets. And we're seeing that continuing certainly into this quarter and into the next quarter. We see no change in that pattern.
But at the same time, we have seen all these auto companies reporting great numbers as far as sales numbers are concerned. Have you seen any sort of a positive impact as far as your order book is concerned from them?
We saw nothing in the January to March quarter. I think we are seeing some uplift in this current quarter, the first quarter of our new financial year, but it's very fragmented. There are winners and losers within the portfolio. And I think if you look at commercial vehicles, which is getting a lot of press at the moment, it has increased slightly, but I think we all need to recognise it's coming off an extremely low base. So let me see the substance of that over the next few months before we say there's a full recovery on the way.
And what about the margin picture? How does that look?
Pretty stable now. I mean, the margins as a percentage has fallen from last quarter, but that's purely a mathematical calculation due to the shift to our global businesses. Global businesses tend to have lower margins between sort of 9 and 11%, whereas India have double digits. So that's purely a mathematical calculation, and I would expect that to pretty much be in line going forward.
And lastly, what's the guidance that you would give for the investors for FY17?
I think our overall drive for 16-17 is really the debt reduction program. Our debt is too high. We recognise that. We need to bring it to in line with our operating structures. And I think that the push that we're doing, all the effort we're doing in terms of the asset monetisation and now the institutional investor program, I think that is the big focus for Amtek in this year.
Mr. Flintham, thank you very much for joining us here on NDTV Profit and sharing with us the details about the quarter gone by and, of course, the outlook ahead. Currently, they have a debt of about 14,800 crore rupees and their target is to reduce it by 2/3 in the next 2 to 3 years. They are expecting to bring that down to 6,000 to 7,000 crore rupees. The stock is close to that highest point of the day. It's up close to 5% right now. That's Amtek Auto for you, for whom, of course, the focus from now on will just remain on reducing the debt. Of course, the environment remains quite challenging, at this point in time as far as the domestic business is concerned, and they're expecting things to start looking better only from the third quarter itself.